Perfect. So good morning, everyone. So thank you, Pete, for having me over at the conference. So my name is Thomas Jacob, and I work in the Oilfield Services Research Team at Rystad Energy. So while the slides are going up, I'll maybe talk a little bit about, I've been at the conference for around 7 years now. So obviously been through the boom that we saw in 13, 14, the bus cycle that we saw in 15, 16, and then sort of 17, 18 again, having that boom cycle, and finally sort of a period of calmness, I think, in 2019. But now, as I'm sure all of you are really looking forward to getting out of 2020, so really looking forward to that. Maybe I'll just start off with introduction to Rystad, and then while the slides are up, we can get going. So Pete has really asked me to talk about really what the outlook for the frac sand space is. So frac sand demand, supply, how that fits in as we look at 2021 and beyond. And that's what I'm hoping to do at this presentation. So about Rystad, so we are a data analytics and consulting firm headquartered out of Oslo, Norway. So we have offices across the world. In North America specifically, we have 3 offices now actually. So one in Houston, which is where I work, one in New York, and we recently opened an office in Denver, Colorado. And we are also planning to open an office in Calgary, Canada. So the agenda for today that I thought I'd put together is really talk a little bit about our methodology, and then dive into drilling and completions activity forecasts, so what to expect in 2021 and the next decade really, and then talk specifically about the frac sand space and maybe a few markets outside of the US as well, because there's been some chatter around that, so I thought I'd spend a little bit of time talking about that as well. So really our methodology in my team specifically, we use a 4-pronged approach. So we have primary intelligence, secondary intelligence, proprietary data, and in-house experts. So within Rystad, we pretty much track every single well that's permitted, drilled, fracked, put on production, how much proppant was used, who was the operator. So we track all of that really closely. But I think there's 2 aspects: sand companies, truckers. So really getting an understanding of what's happening on the ground with what the data is actually showing. And just within the past 4 to 5 months, we've now started tracking satellite data. Using that, we can now get a really good understanding of what activity is in near real time. So really filling in the gaps where the state regulatory agencies and Frac Focus and other places lag in reporting. So that's actually helped us really get a much accurate picture of what's happening on the ground. So starting off, I know that Marshall can spend a lot of time talking about this, but I want to just give you some context on what our view is on oil prices. So we start off, obviously there's a lot of things up in the air, right? So 2020, we think we'll average around $39 per barrel. And 2021, there's a lot of wild cards. So we have, Biden coming in, and what happens with Iran is a big issue. When do we get a vaccine out? That's another issue. But when you factor all of that in, at least our official view is we'll start off the year at around 40, and then we exit the year at around 50. So on average, you will be in the mid-40s in next year. And 2022 and beyond will be the early to mid-50s. And on the gas side, we are a little more, I think, bullish. So we have gas prices around the $3 per barrel, $3 per MMBTU in 2021 and beyond. So these are real prices, that is. So just to take a step back on what really transpired. So we got a question about ducts and what that means and all of that. So I tried to go into that in a little more detail. So what you're looking at now is really a chart that shows what the frac spread has done, frac spread count has done, what the horizontal rig count has done. And I've scaled the y-axis in such a way that when one of these lines lead or lag the other, you have a drawdown of ducts and a buildup of ducts. So really, as you can see, frac fleets fell at a much faster rate than rigs when the downturn happened. And then you had production that was being curtailed. So in the downturn, that was the order of events. But then in the upturn, you'd have the exact opposite, right? So you have curtailed production being brought back, then you have the frac fleets being brought back, then you have the rigs being brought back. And that's being shown right now. So as you can see, in the later part of that chart, towards the right-hand side, really that frac fleet count is coming up and you're drawing down on that DUC count. So just to give you a snapshot, we're looking at started frac operations in North America by month. And what I've done is we've in the later part of this year, the satellite data really comes in and it gives you a sense for where things are. So definitely the bottom was in May of 2020, as you can see, and then there was a step change in activity in July, and then there was again a step change up in activity in September, October, and from the looks of it, November is shaping up to be very similar to October, and December we were expecting a little bit of a slowdown. But when you factor all of that in, Q3 definitely up around 40-45%, and Q4 from everything that we've seen so far will probably be up flattish, slightly 0 to 5% up in Q4. So I think when COVID really hit, there was a lot of uncertainty out there. So operators really went into sort of a shell. So they had an overcorrection, and now as oil prices have increased and there's a little bit more visibility into 2021 and beyond, now we're getting back to activity levels where it really needed to be. So I think there's a little bit of an overcorrection. So what I mean by that is if oil prices were 40 and if OPEC hadn't reined in supply, there was no COVID, activity levels in the US would be higher than where it is right now. So I think that what we're seeing now is where we'd expect activity levels to be. So from that overcorrection that we saw in May, June, now we're getting to where it really needs to be sort of. And looking at this chart, so this is US oil DUC counts, right? So looking at all the major oil plays, so Permian, the Eagle Ford, the Bakken, DJ. So what you can see is there's always been around 3,000 to 3,500 oil DUCs as you look over the past 3 to 4 years. And again, towards the right side of that chart, what you can see is the rigs were still working when the frac fleets were being stacked, and you had an abnormal buildup of DUCs all the way up to like May and June, right? So that's at an all-time high over the past 7 years. And since then, with frac fleets being put back into the field, you're seeing that drawdown. So some of the things that we think about quite a bit is in 17, 18, and 19, it was 3 years when you had a lot of growth with respect to US production. And now, based on the operator conversations that we've been having, the public guidance that some of these operators have given us, everyone's going into sort of a maintenance mode, right? So what is that steady state DUC count going to be as we get further into 2021 is a big question. So my thesis is we'll still keep seeing that drawdown more and more as we get into 2021, and then we get to a new steady state of DUCs in which you maintain production. So exactly what that level is it 2,500, 3,000? It's something that we still think about quite a bit. So on the ratio between frac fleets and rigs, when you think about it, a rig can drill around 1.4 to 1.6 wells a month, whereas a frac fleet can complete around 4 to 4.5 wells per month. So it's much harder to build up DUCs than to draw them down. And the frac fleets are actually getting faster and faster with the advent of simul-fracs and all of that. You're fracking way more wells on a per fleet basis. So when you look at that ratio, one frac fleet is really chasing 3 rigs, right? So as Marshall is kind of saying that we really need to see the rig count around that 390, 400 mark for you to really stabilize the DUCs. And we're not going to get there for a while, right? So we will see that drawdown of DUCs as we get into 2021. So one other concept that I want to talk about a little bit is something called reinvestment rates. So reinvestment rates is really the ratio of your capex, drilling and completions capex, to really the after-tax cash flow profit, right? So what we've seen here is really that reinvestment rate by region. So the Permian is actually the green bar, and all of the other oil regions have aggregated that into that yellow bar, and we're looking at it by year. So back in 2014-15, Permian had really high reinvestment rates because it was still being developed and it wasn't a mature play like the Bakken and the Eagle Ford. So you needed a lot of capital being pushed into the Permian to develop it to where it needs to be. But ever since 2019, there has been a push from the investors for these E&Ps to really grow but be within cash flow, right? So we saw that in 19, and a lot of companies, at least on the public domain, were able to do that in 19. But we still have a pretty high reinvestment rate in 2019 because there was a big increase in capital expenditure from the private operator side. So 2020, we are on track for the first time for the Permian to be below 100% when it comes to reinvestment rates. And looking beyond that, we think that optimal reinvestment rates would be trending more towards that 60% mark. So what that means is, in the past, if you would have seen oil prices shoot up by $10, you would see a similar increase in your drilling and completions programs. You wouldn't see that now. So a lot of that excess money would be spent in managing debt, stock buybacks, dividends for the shareholders and things like that. So it's going to be a while before we can get back to that 75-80% reinvestment rate in the US as a whole. And looking at 2021, so we do track all the operators and what they've been saying as. And this year for us, it has been challenging because a lot of people are putting off, coming up with a budget, and because it's still a lot of uncertainty. So we've looked at 23 operators that have given some guidance, and they account for around 41% of US production. And what we're seeing is we're seeing a 10 to 30% decline in your capex in 2021 with just these dedicated oil shale producers. But when you factor in privates and all of that, I think we end up somewhere between 5 to 10% down in capex in 2021 versus 2020. So despite oil prices being higher in 2021 than 2020, we have capex still going to be down in 2021. But that doesn't necessarily mean completions activity is going to decline, because when you have a buildup of ducts and you're going to draw those down. So a lot of that capex that will be spent in 2021, I think, will be weighted more towards completions than drilling. The other factor is the service price deflation we saw in this as soon as COVID hit. I think that bleeds into 2021 too, so you can essentially do more work with the same amount of capital. So when you factor all of that in, we do expect a 12%, 30% increase in completions activity in 2021. And then looking beyond that, this is horizontal wells frac, which is, I think, the best metric to look at with respect to completions activity. We will get back to around 10,000 fracs by 2023. So 2022, 2023, despite oil prices hovering around that early to mid 50s, we don't get anywhere close to where we were in 2019. To give you some context, 2019 WTI prices was around 55, 57. So it's not a lot of delta when it comes to that, right? So again, this is with a reinvestment rate of around 60-65%. So there is more upside to this in the outer years if operators are more comfortable ramping up their drilling and completions programs and really increasing that reinvestment rate. But if we see it hovering more towards that 60% mark, the increase in activity is not going to be as steep as what we've seen in previous years, like in 17 and 18. So one other thing that I do want to talk about is really the efficiency gains that we've seen in the US specifically, right? So almost all E&Ps exactly know what their well designs should be. So how much proppant should I use? What should be my stage spacing? What should be my lateral length? So everyone kind of has a very good understanding of that. So the past decade, with them tweaking those well designs parameters to optimize for production, they exactly know where they need to be. So so the next phase would be really focusing on efficiencies to get costs lower. So ever since 2018, there has been a very significant increase in any sort of efficiency metric, whether it be proppant pump per day, stimulated footage per day. So that's been on a significant increase. This is the US lower 48. And now with a lot of operators looking at simul-fracs, that number is even trending higher. So what we wanted to do is on the frac services side, on the pressure pumping side, even though you had increasing demand in 17-18, we actually saw pressure pumping demand decline. And the primary reason for that was this increase in efficiencies, right? So what we did is we assumed that we're going to keep on this trajectory going forward. So essentially we reach the 75th percentile of where we are now with respect to efficiencies as the average by the end of 2022. And then how would that translate to a free fleet count? And what we are seeing is you wouldn't need as many fleets, right? So if you needed 250 to 300 fleets, if we still keep pricing on efficiency gains all the way to 2022, 2023, we'd probably need only 200 to 250. The other side to that would be the fleet size is also increasing because with simul-fracs you need a much bigger frac fleet on site as well. So there's a lot of things that are kind of changing in that space. And then finally, I guess, on the pressure pumping side, we are seeing a lot of equipment being cut up for sure. So last year we saw around 4 million horsepower exit the market. And this year, our expectation is we'll probably see another 4 million exit the market. So if you're a pressure pumper, there's really two types of pressure pumping companies that we see can exist. So one is you're either a Halliburton, Liberty next year, where you have significant footprint across multiple basins, or you're a small 2 to 4 frac fleet or 5 frac fleet company with very little overhead, and you can operate in these lower margins. So pretty much everyone in that middle have to figure out a way to kind of get into one of these buckets. So either you do what Liberty and Munson did and go to that bigger bucket, or you do what BJ is doing and go to that smaller bucket. So there's no way these middle tier companies can exist, and so that's the reason why 2021, from the looks of it, we aren't factoring in a significant uptick in activity, so the recovery is going to be slow, and hence we will expect to see more consolidation in that space. So that's giving you some context on the pressure pumping side. And with that, let me jump into the frac sand space. So from a demand perspective, obviously this year has been extremely tough for in-basin sand providers and northern white sand providers. So demand has declined from 114 million tons in 2019 to around 64 in 2020. And next year we are expecting a 10 to 15% increase. So we'll get to around 72, and then from then on we'll get to 83, and then finally 95. There is upside to this. Again, if the reinvestment rates recover in the outer years, there's some upside to this. But for now, we are factoring that in. We think this is the more realistic scenario there. And from all the drivers, right, when you look at demand, so you have the amount of sand that's consumed on a per well basis, so you have sand intensity, and then you have the actual number of wells that are fracked. So what we are seeing is, obviously, as I said, the operators have a really good understanding of what their designs are. So from that perspective, the amount of sand that's being consumed on a per well basis is normalizing now. The only upside there is increasing lateral lengths, primarily coming from the Permian Delaware. So when in Q2 of this year, we did see a step increase, but a lot of that's just driven by high grading. You have the best wells and the best operators working, but as activity picked back up, now we're getting back to where it needs to be. So not a lot of upside when it comes to the amount of sand that's being consumed on a per well basis. Same thing with sand intensity. It's been flat for a couple of years now, and we don't expect there to be a step change up anytime soon. So again, not a lot of upside from that metric. So one thing that we do focus a lot is really in-basin sand versus northern white sand. And this is looking at the adoption rate for in-basin sand in all of these different basins. So the Marcellus Utica region, the Bakken, and the Powder River, and other secondary plays in the US still are going to be northern white sand centers, although you could argue that the Marcellus Utica region, you're seeing a lot of sand come from Missouri, Mississippi, so it's not truly coming from Wisconsin, Illinois, Minnesota. And when you look at, say, the Permian, Eagle Ford, Haynesville, Mid-Con, all of those regions are now using well above 50% with respect to adoption rate. So in the Permian, for example, we see it as high as 95, if not more. Eagle Ford, I think Eagle Ford, one thing that we've seen is with COVID, that's accelerated actually an increase in adoption rate. So there were a lot of operators that hadn't really used in basin sand in Eagle Ford, but with COVID hitting, with again pressure to reduce costs, they were forced to use it. So there have been some folks who've been going back and forth. So we've increased our adoption rate for in basin sand in the Eagle Ford, and then the Mid-Con. So the Mid-Con, I think, is one region where, except for one operator, I think everyone else is using in basin sand. But the challenge is that the outlook for that play has significantly been reduced with players like sitting in the space and people really reducing their drilling and completions programs, right? So when we look at supply, on the northern white sand space, we've seen a lot of supply being put out of the market. So in 2019, we saw around 42 million tons come off, and this year we expect there to be around 17 million more in absolute retirements. So all of that baked in, we probably see around 55 to 60 million tons exit the space. And the reason for that, we believe, is when you look at the adoption rate, as I showed you on this chart, around 2/3 of demand now is being met by in-basin sand. So northern white sand demand, I think even in a best case scenario, demand is going to be capped around 35 to 40 million tons. I think that's the max demand that you'll see in the next 5 years. And hence, supply would have to rationalize to exactly meet that. So we think there will be around 40 to 48 million tons of supply still producing in the northern white sand space as we look forward to that. And looking at supply in the Permian, I mean, so 2020 was one of the most difficult years out there. And what we've seen is, except for maybe a couple of mines, everyone is still around, right? So no one's truly shut down shop, no one's truly liquidated their assets. So everyone is still around. And what we are seeing now is, as activity has picked back up, you're slowly seeing the idle mines being put back to work. So obviously that always keeps a lid on pricing. In the Eagle Ford, a similar scenario. A lot of the mines in the Eagle Ford, for example, they have industrial exposure, they're privately owned, so they can do things a little different than other companies. So none of them have truly gone away. And with some more upside on the Eagle Ford and basin sand space, we don't think anyone's going to truly shut down there as well. But the Mid-Con, for sure, is going to be different, right? So from when you look at demand, we see demand hovering between 2 to 4 million tons for the next 5 years. And let's say even if it goes to 5 million tons, you still have a lot of excess supply there. And when you look at the geography of where these mines are and where demand is, so a lot of the dedicated and basin sand mines are in the stack side. So, and on the scoop side, you have the 3 industrial mines that still supply sand to that region, and except for, I think, one mine, Titan Lansing, everyone else is pretty much serving the stack. So there has to be some rationalization, so whether that's through consolidation, whether that's through downsizing your operations or cutting down on demand completely, we see some consolidation in the in-basin sand space in the Mid-Con in 2021 and beyond. And finally, on the pricing side, as you remember, January and February of this year was really good. Before COVID hit, it feels so far away. So pricing was in that $20 mark for in-basin sand in the Permian. Northern white sand prices were in the 20s. Eagle Ford prices were in the 30s. But obviously, then what we've seen is pricing has really come down. So in the Permian now, it's around the $13, $14 mark with some delta for the 40/70 product. Eagle Ford, it's below 20. Mid-Con is below 20. So as you look towards 2021, what we are expecting is pricing to firm up a little more. So a lot of that irrational pricing with sub-10 pricing in the Permian, that should go away. And you would expect pricing to be around that $14, $15 mark, with some upside on the spot market depending on when activity picks back up and ramps down. So, but there'll always be a cap on pricing next year due to that supply overhang that we're seeing. And when you see with the price deflation that the industry has seen, you can kind of get a sense for how much proppant costs have reduced for these operators over the past 7 or 8 months or so. So in basin, sand users in the Permian have seen a 20-25% decline in their proppant costs. It's much higher in the Eagle Ford, and some of this definitely bleeds through to 2021, which is exactly why we believe that there could still be upside to completions activity despite having a lower capex environment. And in the interest of time, maybe I'll quickly talk about some international markets, right? So outside of the US and conventional shale, you really have obviously Canada, you have the Vaca Muerta in Argentina, and then you have obviously the Middle East, Russia, China, and places like that. So starting off on the Canadian side, this is looking at your frac fleet count by week, and what we saw at the bottom was around 3 or 4 fleets working, and since then we've had around 8 to 10 fleets working on average for the past 1 or 2 months. And as you look into 2021, at least in Q1, we are expecting there to be an increase, but beyond that, it's still a lot of things are still up in the air. So you have a lot of companies pushing out their completion programs further and further out. So when you bake all of that in, I think from a demand side, 2021 demand is going to be very similar to 2020 demand. So Q1 in 2020 was very high, which is why the demand number is higher, but activity never truly recovers, obviously, to where we were in 2020. So from a demand side, I think proppant demand close to slightly up in the Canadian market. And then in Argentina, what you're looking at is horizontal POP wells, that's wells that are put on production. What we've seen is definitely a lot of demand destruction. Very few wells being completed both on the oil side and the gas side. And obviously, when this isn't enough to maintain production. So when you look at oil production that's coming out of the Vaca Muerta, that decline that you saw was really the curtailments that we saw, and then since then things have recovered as operators have put things back online. But with the number of wells that are being put online now, we will see decline in oil production coming out of the Vaca Muerta from Q4 and well into 2021. But one thing that we've seen, I've spent some time in the Vaca Muerta as well. So in the US, I think in the last decade, people figured out their well designs, they got to where they needed to be. And now that focus on efficiencies is happening. But in the Vaca Muerta, there are still learnings to be had when it comes to their well design, what the state spacing should be. So that hasn't really been truly figured out. So there is still some room to grow, which is what you're seeing here with respect to sand intensity. It's still increasing. That's the red bar right there. So that's still increasing even up to 2020. And what you're looking at here is really your lateral length. So that's also been increasing. And if you look at the 9,000 to 10,000 feet and greater than 10,000 feet, again, very few wells in those buckets. So as the Vaca Muerta matures, we'd expect things to shift towards those larger buckets, which hasn't happened till now. And so when we factor all of this in, that focus on efficiencies, none of that has truly flowed, has come through to the Vaca Muerta. So when you look at the suppliers that are still out there, so you have Schlumberger, you have Baker Hughes, you have Frac, you have Weatherford. We've seen everyone downsize their operations. So Schlumberger moving a few assets of theirs to the Middle East. We've heard Baker Hughes is exiting that space quite a bit. So just as you're seeing in the US, everyone is downsizing their operations, even in the Vaca Muerta. And so definitely 2021 isn't truly going to be a year where you see a lot of recovery even there. But Middle East, there is some chatter about the Middle East. There's a field called Jafurah Fields in Saudi Arabia that is seeing some investments in that space, both on the sand side and on the pressure pumping side. China is another place that we are getting more questions on, and places that people are looking to get into. So outside of the US, really it's these markets that are showing some signs, but when you put things in perspective, it's, from an activity standpoint, it's a very small portion of activity in the US. So to conclude, I guess we've learned a lot over the past 4 to 5 years, especially in the US, and operators are constantly pushing boundaries that we haven't really pushed. So as I said, now people are using in-basin sand, they're comfortable with it. Even on the water side, we are seeing a lot of E&Ps really pumping down low quality water. So something that they wouldn't have necessarily done 3 or 4 years back. Chemical concentrations are going down. So a lot of boundaries are being pushed that have never been pushed. So whether that shows up in a decline in your EURs later on is something that we just don't know, because we haven't crossed these boundaries before. But all in all, I think in the next decade, it's not going to be it's not going to be a robust, rosy picture as we've had over the past 3 years. And we also do see a dichotomy between oil and gas, right? So our expectation is you would reach peak oil demand sometime in this decade, probably 2026, 2027. And what COVID has really done is accelerated that. So you would peak earlier and you would peak lower, around 103, 104 million barrels per day. But on the gas side, there is still some room to grow. So, for example, LNG demand coming out of Asia and places like that, we still see, despite renewables coming in, we can still see the gas side of things being a little more stable than oil. So the best days for oil may be behind us as we think about peak oil demand and all of that. And with that, I open up the floor for questions.
Great. You're